I think this is something that we debating with among kind of crypto funds, for example. Clearly, institutions aren't done. There's a lot of pensions and endowments that are continuing to allocate, that are allocating in slow motion.
Because they outpaced retail for the first time in Q4 of last year, right?
They did. When you say outpaced for the first time, that sounds very quantified. You may actually have seen numbers I haven't.
I saw something that was published, I think it was in the S1 on Coinbase, saying that there was more institutional buyers in Q4 of last year than there was retail purchasers in terms of volume of Bitcoin.
Got it.
Which was interesting. That was like the first time I had heard that was the case. And I just feel like we're so early on the institutional buying side.
Agreed. Although we were in 2017 too, right? So like you could have made the argument at the end of 2017 that, hey, Tesla hasn't bought yet, MicroStrategy hasn't bought yet, these pensions haven't bought yet. And that was an accurate statement, but it didn't mean that we weren't about to crash 80%. Right. So a key question is how consistent will that institutional flow be? So like right now, we see zero, I don't want to exaggerate. We see very little institutional buying at this moment. And by this moment, I oversay the last 3 weeks. Very little additional institutional buying.
Hey everyone, welcome back to the Maverick channel. Now, I've always asked myself this question and I've never found an answer anywhere online. The closest thing that I found an answer to this particular question was a recent podcast that I listened to, and that was a section of a clip you heard at the start of this video. Essentially, the question is, what happens to decentralized finance when we're in a bear market? Now, I don't want to spread fear that we're in a bear market, but I've been in crypto since 2017. I was new in early 2017. At the time, I didn't have that sixth sense to tell whether we were at the beginning of a bear market, because I still had that excitement. Markets are going up, markets will keep going up forever. And you don't have that frame of reference or even a little bit of experience in understanding the market sentiment. So what I know from cryptocurrency space is that it's a direct mirror of human emotions and human sentiment. Basically, if you want to know how humans behave, look at the markets, look at the charts. And right now what I'm sensing is that there is a general slowdown. There is a general sort of this sort of brewing, boring sentiment within the cryptocurrency market. And I bet if Elon Musk was to tweet about Doge right now, not too many people will even bat an eye, because it's not as exciting as before. So you have to look out for things like that, and usually things like that slow down the market. So things you have to look for, and I also want to talk about ways you can protect yourself, especially by leveraging DeFi and also being careful. First of all, we understand that most of the institutional money this time round came in before the bull market started, unlike in the years before. Apparently, most of the huge investors, for example, you see people like Michael Saylor of MicroStrategy have been very bullish on Bitcoin. So you have to understand that these people, before they went out on Twitter and started talking about how much Bitcoin they bought and all this, they must have spoken to a lot of their billionaire friends and told them how exciting this thing is and gave them the numbers of where the trend is going and how valuable this Bitcoin thing might be. So there's apparently some statistics, I don't know from Coinbase but I was listening to this guy, I think he's Kevin Rose from the podcast that I was playing, and he was saying that there was a lot of institutional buying of digital currencies from Q4 of last year, so basically the end of last year, and majority of these institutions are just profit driven. And from what I'm seeing from the current sentiment in the market, frankly speaking, there's not a lot of new money flowing into the market right now. So you have to be very, very cautious. If you were an early investor into the market, or if you realize some sort of profit in the market, you want to take out that initial investment. You want to take out your initial investment. If you invested $1,000, you want to take out that $1,000 profit, or you want to take out that $1,500 profit, and the money that's left there is basically money you're playing with. So essentially, look at decentralized finance platforms. Personally, I'm using Binance and not Ethereum due to the high fees. That's all. That's the only reason. So Binance is the next trusted sort of getting established platform that's out there, and I pay the least fees, and I can sort of strategize as a person that pretty much depends on cryptocurrencies to put food on the table. I have to watch what I do, and I make the decisions that I make based on how I'm going to live my life, or the best strategy for how I'm going to help my personal wealth grow. When I see tweets from people like CZ Binance on Twitter saying that when you hodl long enough, you've been hodling for so many years and not cashing out and not being scared, you have to understand that they're making decisions based on their situation. So you need to make your situations based on your situation. If you have a stable job and you're earning a good salary, a good income, then you can afford to weather out the bear market, and all you can do is dollar cost average in as the prices keep going down. If you're going to if you've betted a large sum of your savings onto the onto cryptocurrencies, then of course you have to watch out for cashing out your initial investment, and then making sure that the money you keep in there is extra money that you hope in the future will reproduce itself. So you want to look out for, in case you've cashed out money, you want to look out for decentralized finance platforms. But first of all, you want to look at the team, you want to look at their funding, you want to look at how novel their idea is. You have to make sure it's a good team that's well funded. So in case of a cryptocurrency collapse, you don't want the team to the platform to disappear because they don't have any money to fund their team. They don't have any money to maintain their website. They basically don't have any finances of any sorts to keep that going. And it turns out that must have been a scam of some sorts, but you can't tell initially. So you want to look out for established platforms. For example, in Binance, I could say maybe PancakeSwap, Pancake Bunny, and then the others you have to do your research. Try to avoid platforms that just appeared last week or yesterday. You have to look at platforms that are establishing themselves, that are trying to establish themselves, and that's where you want to put some of your liquidity. So my strategy is, especially with stablecoins, there's this pair on the Binance chain. It's the Binance USD token, and there's this token called VI. So if you look at Ethereum, there's MakerDAO. MakerDAO creates this token called DAI, which is a decentralized collateralized stablecoin. On the Binance Smart Chain, there's Nexus. Nexus is basically they created a stablecoin called VI, which is a collateralized stablecoin, decentralized stablecoin. So when you go to most of the yield farming aggregators, the automated market makers like Pancake Bunny, PancakeSwap, and Planet Finance. Though Planet Finance is kind of new, so guys be careful, though I did a video about them. Usually that pair, the BUSD and the VI stablecoin, they have the highest yield. So you may want to split your liquidity between those two, because as you're providing that liquidity, you're getting a relatively good percentage. I've seen 30%, I've seen 50% sometimes. It keeps fluctuating. So you want to protect yourself from impermanent loss by providing liquidity using those two stable coins. And then that extra money that you have, you want to try and have it in very good tokens that you believe in, that provide some sort of yield. So for example, we're always talking about Fetch. If you have your extra money in Fetch, that's staking reward that you're always getting regardless of what the market prices are doing, and you know that you cashed out your initial investment and you're still increasing the amount of Fed tokens you have. Or if you're using a trusted decentralized exchange, you know that you're holding their token, you're staking their token, you're providing liquidity with that token with either a stable coin, so you paired the utility token that exchange is giving with a stable coin, or you're providing single-sided liquidity. You're just providing that stable coin, and it keeps growing and creating for you income as time goes on. So in that way, you're protecting your cashed out money, and in a way, and on the other end, you're also building more of some of these coins that you're holding. So that's a good strategy. Look out for the team, make sure it's a trusted platform that's not going to disappear as the markets have crashed. Of course, if we're in a multi-year bull market, you have to understand that the reason why also these yields are sustainable is because there's constant new capital flowing into the market. But however, eventually, as anything grows, there has to be that equilibrium, reversal, inflection point that that curve going up eventually meets itself and starts going down, because the number of people getting onto these platforms is going down, or it has reached that equilibrium point, and there's no more sustainability. So you don't want to be engaged on a platform that's providing tokenomics that are very inflationary in nature. So you have to put these things you have to take care about how their token supply is, how their funding models are, because this whole yield farming thing, if they have compounded yielding, you have to make sure you're on a platform that compounds your yield so you can maximize your profits. So whatever profits you get, they are maybe automatically put back into your pool, and you can get more profits on this. Yeah, as you understand, most of DeFi right now is highly speculative. It's even if it's hard to kind of see it, but it's highly speculative. As I've said, there's still new capital that creates this market movement. It creates this sort of this impression that the markets are doing well, that these yields are going to be sustainable forever, but that's not the case. Usually when, as you all know, as Bitcoin drops, people that are holding other digital currencies will sell those digital currencies to buy Bitcoin on the low price, or they'll sell those digital currencies to buy stablecoin, or they'll sell Bitcoin itself, as opposed to they'll sell either the altcoins or Bitcoin. So it creates this cascading effect that leads to a market tumble. Again, I'm not trying to spread any sort of fear, but you have to look out for these trends. And right now, personally, to me, I could be 100% wrong. The trend looks like it's slowing down. I'm not saying the market is going to go down. It might just remain flat, but it might go up, but you have to find ways of protecting yourself. The other way that DeFi platforms earn is by exchange fees. So as people exchange tokens within the exchange, there's always a small fee charged, and usually these fees are put into the liquidity pool where people are mining, where liquidity providers are engaged. So if there is less of these swaps between different tokens, or even if as the markets are going down, maybe people panic selling, those swaps are there, but they're of a lower value. So there's going to be lower value accrued on these pools. So I think that's all I want to talk about in this video. It's essentially, how do you protect yourself, or how do you try and protect yourself? Avoid greed. When the market, these things are always repeated, but they're very fundamental. They're very important, however simple they may seem. Avoid greed. When the market is extremely greedy, extremely excited, that's when you have to get out. When the market is very fearful, that's when you have to get in. However, if you're sensing a bear trend, you have to have money on the side to help yourself keep calm, so that you don't panic sell in case the markets collapse, or you do not do something irrational depending on how the markets are moving. No one has a crystal ball. We're all trying to go through these things and understand these market trends, because crypto is crazy. No one knows what it's going to do. No one knows what is going to happen ultimately. But we try to read between the lines so that we protect ourselves in the best way that we can. Guys, I hope you learned something from this video today. I've put the audio that I played at the beginning of this video in the description in case you want to listen to it. I think it was an amazing conversation. It's a very good analogy of, looking at market sentiment and what the cryptocurrency space has been doing. Institutional investors, when retail investors came in, towards the end, it will help give you some perspective on how things are moving. All right, guys, take care. Thank you for watching. See you on the next one. Bye bye.